Let's start out by looking at the homework for Chapter 17. I'm on page 1035 of your book, exercise 17-2. This is for Lino Company. They have a worksheet here where they want to do the indirect method of the operating cash flows. And the way you do this is you take your net income, which is 150, and you make adjustments to this for how these items change during the year, from the beginning of the year to the end of the year. So these are the adjusting items. This is net income. And we get to the right file here. So what I've already done is kind of put this together for us. So this starts out with net income of 150. And then it says here, increase in AR. So kind of a rule of thumb when it comes to looking at current assets and current liabilities and then making adjustments on the cash flow from operations is that assets are opposite sign. Okay, so let's go back to here and look at receivables went up and the allowance also went up, but we're looking at the net amount. So you want to take a look at the receivable minus the allowance in both years, but the amount went up. So if I go back and show you my formula, that's what I double clicked on here. Is I just took the current year, the end of the current year and the prior year, beginning of year, and I just did subtractions, but I just multiplied by -1 to show that we need to make a deduction to that. So just take the current number minus the prior number. That's your change, but then make sure you're adjusting your change to be increased or decreased. But this is an increase because assets are opposite. Okay, so remember that this is about cash flows. If receivables go up, I'm not collecting as much, so that's why we subtract. Then I do my prepaid. I've got my prepaid amount here. It goes down. It goes from 12.4 to 8.2, so that's a decrease of 4,200. So again, I go opposite sign, assets being opposite. So as prepayments go down, that'd be an add to our net income. Then the last one is the simple one here for accounts payable. This goes up 19.4 to 22.4, an increase of 3,000. That $3,000 increase then is also an increase here. So liabilities go the same sign, increase, increase. So I take my net income, I just add down here to get my adjustments, and so my cash flow from operations is 151,400. Let me get rid of this spreadsheet I'm not using. Okay, so 151,400. That was exercise 17-2. Okay, the next one we'll take a look at, and I'm skipping anything that's direct, is 17-4. And 17-4 is just a way to help us determine collections from customers. And this one has a twist in it, which is what separates this from Chapter 4. Is this we did something similar like this in Chapter 4, but we're adding a twist to it now. It says that King Corporation wrote off the account receivables of $25,000 and made sales on account of $710,000. Other information about the sales activities is as follows. So we've got beginning and ending receivable, beginning ending allowance. In addition, they accepted a $6,000 note from a customer whose account was overdue. They collected $2,300 on that note during 17. So just kind of be aware of that too. So lots of going on here. Let's just make sure that we're able to calculate the answer, which is how much cash was collected during the year. Okay, so let's just go ahead and kind of do a T account, and we'll do a T account for AR. And of course, we'll have kind of our debits and credits here. So just kind of imagine we've got a T account, and let's kind of just make this be the left-hand side here too, so it's easier to follow that it's a T account. Like that. Okay, so there's my T account. And so I've got my beginning balance over here. And my beginning balance is 170. And then that was given to us. And then we know my ending balance, right? The ending balance, they said, was 140. And then we kind of finish the T account by doing a bottom line. Right there. So I got my T account, beginning balance, ending balance, and that just comes right from the numbers here, beginning, ending. And they told us a few things here. They said we did some write-offs of $25,000. We swapped out $6,000 of AR into a note receivable. And we have credit sales of $710. So my debit would be my credit sales. So remember, every time I make a sale on account, I debit receivable, credit sales revenue. So this is my debit to receivable of $710. And let's think of the credits. Well, we know we did a write-off. Anytime you do a write-off, that's a credit to AR. Okay, so there's a write-off that happened. I also did a swap. Okay, basically I swapped a note for AR. Okay, so basically think about what that entry would be. I'd credit account receivable and debit note receivable instead. So, and also know that there's usually an interest component to that too. Not that it matters to us, but there'd also be this interest component. So essentially from there, it's like, what does it take to make us balance? We got the beginning balance, ending balance, all of our sales. We had two credits that happened, the swap and the write-off. So essentially then, what will it take to make this thing balance? And let me see if I can do the math right. And 709. So that was my cash collections. Okay, so just to show you what I did there, I did plus, plus, minus the ending, minus, minus, and that gives me my balance of 709. Okay, so 709 is my cash collections. However, they gave us the twist, and based on that swap of that note, we also collected $2,300 on that. So the question is, what was the amount of cash collected from customers in 17? Well, 709 is a start, so cash from AR is a start. That's the 709. Let me just bring this number down. Well, we also collected from the notes. So cash from note receivable, and that was 2,300. And the sum of the two then is the answer is 711,300. So that's my total answer is 711,300. Okay, the next question is question 5, 17-5. And it says here that Car Inc. reported net income of $300 for the year. And we had some account balances here, equipment, accumulated depreciation, and notes payable. During the year, they sold equipment that cost $25 and had accumulated depreciation of $12 for a gain of $5. They also purchased equipment costing $50 with $20,000 cash and 12% note payable, and depreciation expenses $52,000. So basically, they want us to do two things: what is their cash flow from operations, and what is their cash flow from investing activities. So they want those two items put together for us. Let's do the cash flow from operations first. Let me scroll down to a new area here. Let me format this. Okay, so let's do cash flow from investing, or I'm sorry, operating, cash flow from ops. Remember, we always start out with net income. That's always first. Okay, so that was $300,000. And then we make adjustments. And so we come back to here and we look at the information given to us, and one of the adjustments we always make is depreciation. Remember that depreciation is a non-cash expense, and we need to add that back. So they tell us right here in item 3 that depreciation expense is $52,000. Okay, so we'll add that back. So positive 52. Okay, then go back and they tell us that when they sold that equipment right here, there was a gain of $5,000. So this net income right here of $300 includes a $5,000 gain. However, I don't want this showing here, so we'll do less the gain. I want this showing up in investing instead, so I'm going to subtract $5,000. And then my cash flow from operations is this number right here. Okay, my cash flow from ops is $347 $347,000 even. So the next category is to do investing. So let's do cash flow from investing. And kind of the same story. I have to be kind of careful about what we include and what we don't include. And go back to here. Remember what is investing. It's the purchase and sale of property, plant, and equipment would be kind of one of the main categories. And that's really what's happening here. In item 1, we sold equipment. In item 2, we bought equipment. Okay, so let's go ahead and fill those in. So we have a sale of equipment, and we have the purchase of equipment. Okay, so those are the two. So let's go back and take a look at each one in more detail and make sure we've kind of got all the little details. And this is where, if you were doing this, you'd pull up a company's general ledger and look at all the details that went into the purchases and sales, trying to find those unique items that kind of stand out. And of course, they're telling us that we sold equipment, had depreciation in 12 and a gain of 5. So let's kind of work that through what that means here. So we can do a little sub-schedule off to the right that will calculate the total amount of sale of equipment that goes in the cash flow statement. So let's do it to the right here. And so this was the cost. Okay, what we sold had a cost of 25. Its depreciation, the cum depreciation on it, over the years that we owned it was 12,000. Both of those were given to us. They said cost was 25, depreciation was 12. So we know the book value when we sold it was 13. Okay, so it's the difference between the two is 13. So that's my book value on the equipment that we sold. We know the gain was 5. It gave us that already. We've kind of already used that adjustment also. And so that means the cash received has to be the sum of those last two numbers, the book value and the cash received. The book value and the gain of 5 equals the cash. Okay, so that's the cash received. So the sale of equipment, the net cash realized is $18,000. And so that $5,000 adjustment up here in operations is down here. So we essentially moved it down to here. Okay, so we received $18,000 on a book value of 13, so that 5,000 is hiding out right in here now. Then we do the purchase of equipment, and again, let's do another schedule. We'll do it more to the top here. So when they told us was we bought equipment that cost 50, paid cash of 20, and incurred a note of 30. Okay, so we have to think about this being the cash flow statement. So the cost was 50. This is the purchase. Less the note payable. NP for note payable, and that was 30,000. Because all I really care about is the cash paid. So this is the cash paid. Okay, so I paid 20,000. And actually I should do a subtraction of that. That should be a minus. Okay, cash paid. So my net cash from investing is a negative, which is actually very, very common. Okay, it's 2,000. So that solves that one. So that actually just answers then question 5. I just wanted you to see how that gain on the sale, we have to back it out of operations and essentially reclassify it down into investing. Okay, so that was 17.5. Let's take a look at 17.6. It says here, Superfine collected the following data in preparing its cash flow statement for the year of 17. And this one's going to focus more on, it's more investing and financing. The previous one was operating and investing. This one's investing and financing. So we finally get to take a look at the investing section. And so let's go ahead and do that. Requirement 1 is investing. Requirement 2 is financing. And we'll just go ahead and get a kind of a new blank area down here. So let's do our cash flow from financing. And let's go back, take a look at what happened here, and kind of figure out what belongs where. So bond discount, dividends declared and paid, gain on sale of equipment. Aha! Remember, investing deals with property, plant, and equipment and long-term marketable securities like bonds and common stocks if we buy them as investments. Proceeds from sale of equipment, proceeds from sale of treasury stock, and then purchase of BAS Inc. bonds for $90,000. So let's take a look at the proceeds here. Proceeds from the sale of the equipment. Okay, so that's just $5,000. That's all I need to know. And you just have to really pay attention to how they word things, because the proceeds is the cash received, right? In the previous question, they never told us the cash received, right? They just said cost is 25, depreciation was 12, gain of 5. They never said what the actual cash received was. Well, in this question, they do. So you really have to watch that. The proceeds from the sale was $5,000. So that was pretty easy. Sale of equipment. And it's $5,000. Okay. And then remember that we bought an investment. So this is just some other company's bonds we bought off the market. They're not our own bonds that we've issued or our own bonds that we're making principal payments on. So this is a bond of some other company, BAS, and it's just an investment. Okay, and we're going to spend $90,000 on that. Okay, so that's a minus 90. And so that's it. That was my investing. So that's my cash flow from my investments. So now let's do cash flows from financing. And again, go back to what's going on here. Well, again, I care about cash, right? Dividends declared were $22.5. The dividends paid were $19. Well, that's what matters, okay? And so that's the one I care about. And then also the treasury stock one down here. It says proceeds of treasury stock, $37.5. Well, the carrying amount was $32.5, fine, but I received cash when I sold them at $37.5. So that's what matters. So notice that they gave us information here that we didn't use. That's, obviously we've seen that happen before. We know that game. So dividends paid, again, paid being the key word here. And if I pay it, that's cash out. That's a negative. And then proceeds from treasury stock. So that's TS for treasury stock. That's cash in $37.5. Okay, that's a plus. Add that up, and I get $18.5. So I should actually do a few underlines here to make this look more normal. And so that's $18.5, and that's it. That one's very simple. The key is you just have to understand the wording. It can be very tricky. They're giving us information we don't necessarily need. The wording matters. Those little things we've been looking at all throughout the whole class, of course. Let's take a look at 17.7. 17.7, right here. Another investing one, and it says here that ALP Inc. had the following activities for 17. Acquired 2,000 shares of stock of Mabel Inc. for 26. Sold an investment in Rate Motors for 35. Carrying amount was 33. Acquired a $50,000 4-year CD from a bank. During the year, just of $37.50 was paid to ALP. Collected dividends of $1,200 on stock investments. So basically then, what is their cash flow for investments? Cash flow for investments. Again, let's go down, kind of get a new fresh area down here, and go ahead and build this. So we're doing cash flow from investments. And let's go ahead and kind of go back and think this through again. So we're ALP, and think of property, plant, and equipment and marketable securities, right? It's kind of what we're talking about. And nothing here is property, plant, and equipment. It's all marketable securities, which is just fine. And looks like we bought 2,000 shares of an investment, Mabel Inc. for $26,000. So we can definitely classify that. Okay, so purchase of Mabel, and that was for 26. That's a purchase, so it's money out the door. And then we come back and take a look here. It looks like we sold Rate Motors for $35,000. We don't care what the carrying amount was. We just know that we received cash of $35,000. So we just sold another investment. That's all. And that was for $35,000. And then we took some extra cash and we bought a certificate of deposit. We spent $50,000 to buy it. They give us some information here about interest and dividends, and that doesn't matter. That goes through operations. Okay, so that's tricky. That's a key thing to remember is all these investments we have, all we really care about in the investing section is the money I paid to buy them and the money received when I sold them. All of the interest or dividends earned goes through my cash flow from operations. So that's tricky, but just make sure you remember that. So I don't care about operations. The question here is investing. So I don't care what the interest was. I don't care what the dividends were. I just care I spent 50 grand on a CD. Okay, so purchase of CD. And that was for $50,000. So it's a purchase, so it's money out the door of $50,000. Add that down, and that is my cash flow from investing. And typically it's in a negative. And I think we've seen that with everyone that we've done. It's been a negative, so not super unusual by any means. Okay, and so there's one left, and this is the more challenging one. Let's go ahead and do 17-8. It's a longer question, and it's the relationship between the balance sheet and the statement of cash flows. And remember that that's really how you do a cash flow statement, is you're reconciling the change in the balance sheet from beginning of year to end of year. And that's really the worksheet that we worked on back in chapter 4. And that's was really kind of the heart of chapter 4, was just doing that. And this chapter is more about kind of just the unusual little things to worry about. And we're focusing more on investing and financing in this chapter, whereas chapter 4 really kind of hit the operating a lot harder than this chapter does. So they're just helping us understand that relationship with this problem. So we start out with our beginning of year balance sheet right here, a very simplified one, very easy to do balance sheet. Obviously it balances. And they gave us the cash flow statement for the year and a few odds and ends of things that have gone on throughout the year. And then what they want us to do is to figure out what the ending balance sheet is based on that. So instead of saying, here's my beginning balance sheet, my ending balance sheet, build the cash flow statement, instead they're saying, here's your beginning cash flow, or I'm sorry, here's your beginning balance sheet, here's your cash flow statement, here's a few odds and ends, and then go build your ending balance sheet. Okay, so they're just having this kind of drive the car in reverse to figure this out, which again is a common strategy that they like to use. So I've already built a spreadsheet for this for us. Let me get this entirely in my screen the way it should be. Otherwise, you're not going to be able to see it all. There we go. Okay. So this is my spreadsheet to reconcile beginning to end. Okay. So let's go ahead and for my beginning balance sheet, cash was 30. This is just the numbers right from the problem. And then we had equipment worth 36. We had accumulated depreciation of 11,250, leased property of 18, and then we get down and do our lease liability and long-term notes. Actually, right now, lease liability of 18, and then we have capital of 54,750, and we balance. Everything is in balance, so we're in good shape. And now we have some columns here for the various things that have kind of happened for them. So let's go back and take a look here at the adjusting items down here. Letter A, during the year, equipment having a depreciation of $4,500 was sold for a $3,000 gain. A lease payment was made, reducing the lease liability by $3,000. Depreciation expense on leased property was $3,000 and equipment is $8,250. Net income was $14,250. So one of the biggest issues to kind of think through here is the sale of the equipment. Okay, and so let's kind of take a look at that. Kind of making a journal entry will help us a lot with that. And so as we kind of look at everything here, we have to kind of look at the balance sheet given to us, take a look at the cash flow statement here, and right here I notice that there's sale of equipment of $5,250. Okay, so $5,250. And that's important. And also, that selling of the equipment, there was some depreciation, there's a gain, all that stuff. Okay, so but $5,250 is the sale on equipment. So let's go back to here and let's make a journal entry to do that. And I'm going to actually just insert some rows here to make myself some room. Okay, let's figure out a journal entry for that. So I'm going to have a debit to cash, a debit to accumulated depreciation, and then we'll have a credit on the gain and a credit to equipment. And again, they don't always tell us everything. We have to back into things every so often. So per the cash flow statement, I know I've got a debit to cash of $5,250. Okay, so I sold this for $5,250, and that's the number right here. Well, it had depreciation of $4,500 right there, and a gain of $3,000. So I make the depreciation go away by giving it a debit. It told us the gain was $3,000, so that means we have to figure out, well, what was the cost of the equipment? Well, they never really told us. We have to figure it out, and it has to be $6,750 for this entry to balance. So that's the key. Is I got debit here $9,750, a credit of $3, and then I have to make this be an additional credit of $6,750 in order for this to balance. So once I do that, I'm good to go. Okay, so then we balance and we're in good shape. So now that I know that what my equipment cost was, that'll help me figure out my column here for sale of equipment. Well, I know I received cash of $5,250, right? We know that. They told us that. I also just figured out that my cost was $6,750, so I'm going to reduce this by $6,750. The depreciation with that was $4,500, and there was a gain of $3,000 that would have made capital go up. Okay, so a $3,000 gain. So basically, I just took all the components of this journal entry and put them into this column right here. So, with this journal entry, we had to kind of just think through. They told us cash received, depreciation, and the gain, but we had to back into the equipment cost, which is what we then put right there. Okay, and then we have operations, cash flow from operations. Let's go back and take a look at what was given to us, and they tell us right here, net cash provided by operations was $22,500. Okay, so I'm going to put this right here, and cash will go up by $22,500. Okay, well, remember I have to make some adjustments to that. I have to back out depreciation, and so let's go figure out what that is. And they told us, they said over here, they said we have depreciation expense on leased property of $3,000 and depreciation on equipment of $8,250. Let's go ahead and plug that in then. So we go down to this number here, and we drop in the depreciation of $8,250, and you've got the leased equipment right here. Depreciation is $3,000. Okay, so that's my cash flow from operations amounts. So then I do my cash flows from investing, excluding the sale of equipment. Okay, because I already took care of that right here. So let's do my cash flow from investing with everything else. So I come up to here, take a look at my investing category, and kind of figure out what's going on. Well, I've got investments right here of 22.5, and I've got land right here of 13.5. Okay, so those are the two biggies. We've already dealt with the sale of the equipment, so I can't use this 37.50 because it includes the sale of the equipment. So I'm just going to focus on the two purchases. Okay, so my cash outflow is 36, and I'll show you what that is. Well, I bought investments at 22.5, and I bought land of 13.5, and that's the sum of those two right there. So these two equal 36. Well, then I look at my cash flows from financing, and I go down here and take a look. And the good news is, there's really, just take a look down here and go, well, here's my financing. It's this issue of long-term notes and the payment of a lease liability, and then the owner withdrawal, and nothing else. And so these three are pretty straightforward, thankfully. So I can just take those three and just drop them in down here. So I've got my long-term note right here that we took out. So this is my column right here for financing. I've got a long-term note of $15,000. That's a plus. I borrowed money. I made a payment on my lease. And the owner did a withdrawal of 12. Okay, and now I balance. Now I'm good to go. So this then is, let's see, this, I might have put one number in the wrong spot. Oh, I did. Right here, I'm like, this doesn't work. Okay, this number right here, this 3,000, my bad, sorry about that. It goes right here. That's accumulated depreciation. I put it in the lease payment. That was depreciation on the lease property right there, 3,000. Okay, so now I'm good to go right there of 87. And then, and then here, one more item I didn't do, my bad, is right here, because I'm like, this doesn't balance. 11,250 right here I'll show you where that came from. Okay, 11,250. So this and this together goes here. So remember, cash flow from ops is 22.5. I have to back out depreciation, and that the opposite side of that goes right here, because this and this has to balance, right? And it didn't before. So I just got off of my numbers. So 11,250. So just kind of show you this. Every column has to balance. That's really important, which I wasn't paying attention to very well. I missed out on this one. That one didn't balance, but now we're good to go. But just it's a matter of just kind of backing into that final balance sheet. Okay, then you're good to go. Alrighty, if you have questions about anything at all, just let me know. I'm more than happy to help out with any of those things.